Nigeria's central bank delivered another big interest rate hike on Tuesday, responding to a continued rise in inflation, which hit a 28-year high in April. The Central Bank of Nigeria governor, that is Olayemi Cardoso, said the bank's Monetary Policy Committee was faced with a decision to either raise or hold rates, while it observed the impact of previous hikes, but opted for an increase in the interests of price stability. Now, the monetary policy rate was increased by 150 basis points to about 26.25%, the third rate increase this year after hikes of 200 basis points in March and 400 basis points in February. Now, from Lagos, Nigeria, I have joining me Oladipo Ajayi, head of fixed income and FX, Chapel Hill, Denham. Thank you so much, Oladipo, for joining us on the show.
Good morning. Thank you very much, Liko, for having me on.
Yeah, of course, it's a pleasure having you around. Now, given the continued rise in inflation despite repeated interest rate hikes, did you actually anticipate a further increase again? And do you actually support that move by the central bank?
Well, before the meeting, my expectation is that I was expecting the monetary policy guy to actually stay put and maybe at worst do 100 basis points. Sincerely speaking, a 150 basis point to me is very hawkish on the part of the monetary policy guy. And of course, the central bank governor actually explained the reason why they're actually towing that route. But I also feel that they need to actually juxtapose that, what the impact would be on the economy as much as they are taking that decision.
Mm. Well, the MPC actually chose to raise rates to ensure price stability, despite the option to hold rates and further observe the impact of earlier hikes. Now, how impactful have the previous hikes been? We had one in March, we had one in February, and of course, we can say that we've not really seen anything different, so to speak. But from your own end, how do you see the previous hikes and how it has impacted the variables?
Well, previous hike, I think what he has done is that one way or the other, he has actually moved people from the zone of consumption to a more zone of investing. And as a result of that, we've seen a lot of people actually move their fund from consumption to actually investing fund. We saw what happened to short-dated instrument like Treasury bills 1 year that went as high as 27% at the time. So some of these are the impacts. So what he has meant, what that means is that most people are actually investing rather than consuming. And at the same time, what we saw also was the fact that we were able to actually attract a level of foreign inflow from FPI. Between the months of February and March to April, we saw close to about 14 billion worth of transaction on the NAFEM window, and that's actually commendable. And I can boldly say that we wouldn't have seen something like that if not for the body language of the Monetary Policy Committee coupled with the hawkish stance that they have taken. And so also is the fact that I also believe that there's a lag effect between when you make pronouncement and when people start seeing the full impact. And that's one of the reasons why I'm part of the crowd that feels that they should rather just maintain in this month's meeting, considering that we saw a bit of impact of that in the last inflation figure. Of course, headline inflation year on year actually went up to 33.69%. But when you look at month on month, and you also look at the core month on month, and you look at full inflation month on month, of course, you will see that inflation is now accelerating at a decelerating rate. So it means that one way or the other, we are seeing a bit of impact of what they've done in the past 2 months. So for me, I won't say it hasn't been effective, but I just feel that maybe they should have waited it out. They should have waited it out in the month of May and see the full impact of what they've done in the months of February and March.
Okay, so if the Apex Bank is not retaining the rates, are there alternatives in terms of monetary policy measures that the CBN can bring on board? Or maybe there's a fiscal side on the part of government that, of course, the government can tinker with to, of course, deal with the issues around inflation?
Yeah, if you listen to what the CBN governor is post meeting, MPC meeting statements. It mentioned something around the key driver of inflation has been food inflation. And some of the things that actually that he mentioned as as the reason for food inflation, he mentioned insecurity. He mentioned bad infrastructure. He mentioned pass-through effect of FX, and he also mentioned the fact that cost of transporting food from the farm to the place of consumption has actually gone up aggressively. And when you look at all these four line items, I think there's only one that has to do with the Monetary Policy Committee, and that is the FX pass-through effect. When you look at the issue of transportation, that falls within the purview of the fiscal policy guide. When you look at the issue of insecurity, that falls within the purview of the fiscal policy guide. And also, when you look at the issue of infrastructure as well, and that also falls within the purview of the fiscal policy guide. So it means that more of the load sits on the decks of the fiscal policy guide and the monetary policy guide. And I think what the CBN is just trying to do is to ensure that the stability of FX, and when the stability of FX, the effect of the pass-through effect of exchange rate into inflation will actually drop aggressively. And one way or the other, that will contribute their quota to reduce inflation. But that's all said. You can't expect that to now be the only thing that will actually drop inflation. It also means that the fiscal policy guy needs to roll up their sleeve. We have to find a way, lasting solution to insecurity in the food production region. We have to look at a way to actually upgrade infrastructure, road construction, and some of those things that actually be more like a deterrent to actually getting good down to the urban area. And also, we also need to actually look at the issue of transportation. So I feel that the fiscal policy guide need to actually wade in quickly to ensure that they help to actually ameliorate some of these issues, so that the effect of all the effort of the monetary policy guide can be felt. Because I imagine if the fiscal policy guides are not rising up to the challenges, and we continue to raise rates, it gets to a level that the rate hike will not be counterproductive. So it simply means that rather than actually controlling inflation, you would rather actually increase inflation. And what I mean is that it means that cost of finance to manufacturing company will rise, and as cost of finance rise, it means that they will price that into the output cost of their products, and at the end of the day, means that the unit price of their products in the market will go up again. And if that happens, it also means that we'll now be fighting inflation from the angle of cost push rather from the demand push side.
Well, Oladipo, you're actually echoing the stance of so many people within the economic corridor right now, looking at the skewed policies of governments in tackling inflation. Now, you also mentioned FX, and I would want us to also look into that, because that seems to be another factor that is fueling inflation. And of course, we can tie it down to the issue around the volatility of the naira. Now, we just heard that Dangote Refinery has increased diesel fuel from 940 naira to 1,100 naira per litre. Now, these increases continues to stifle businesses and hike inflation rates. So if policies are not holistic, and we have isolated cases like this, of course, it means that the government is not really doing what it needs to do. Of course, dealing with the issue around inflation on all sides. So if you are to look at the FX now, what do you think the right step, what should be the right step that should be taken in dealing with the issue around the volatility of the naira?
Well, on the part of the central bank, to be realistic, they've been doing a lot, and of course, we saw the pressure that came on naira again after naira tested 8,050 levels, sometimes in April, and this could actually be attributed to some of these foreign guys. They're actually testing the plumbing of that model. Because a lot of them have been stuck in Nigeria for close to 4 years now. They're unable to actually repatriate their funds. And a new sheriff came in town trying to reassure them. And at the end of the day, they also want to test the reality of that. And sincerely speaking, we saw that happen, what happened in the equity market, where some of these foreign investors were selling down their portfolio to repatriate fund, and they ended up repatriating the funds. And but what we noticed that we have started seeing some of them coming back again since I guess there's an assurance that the new central bank governor actually meant business. And I feel that what the central bank government needs to do is to continue to actually attract investment. And we saw what happened around the newly licensed INGOs. And what that will do is that it will improve the level of influx of FX into the economy. It will help diaspora remittance. It will reduce cost of diaspora remittance to most people offshore. And another thing also that I also believe will also help is the fact that the central bank need to also ensure that they maintain a window that caters for invisibles. And between and some of the things that actually putting pressure on parallel markets is there are more of the invisible demands as well, because there are people that actually need to pay school fees. There are people that need to actually go on medical tourism. There are people that are going on vacation and the likes. People like that need to actually get to actually access separate. So if there's no window catering for them, of course they need to actually take their demand back to the street, and at the end of the day, we'll start to see pressure coming from that segment of the market. So the central bank need to actually look at the whole model holistically. They need to look at need to ensure that they are actually a window that's catering for each of the demand segments that we have in the country. We have the SME businesses also that needs FX, maybe not in large quantity. Sometimes some of them is as small as $20,000 to actually bring in some of the inputs to their production, or maybe get pay for some services and the like. So there must be a window that's catering from all of these segments of need, because you can't bring all of them under the same headline as NAFEM window. It will be very difficult for most of these to get allocation.
All right, let's now look at the banking industry. Now, the press release mentioned that the CBN maintained an asymmetric corridor of plus 100 minus 300. Now, how effective has this asymmetric corridor been in managing liquidity in the Nigerian banking system?
Sincerely speaking, it has been very, very effective. It has been very, very effective. Currently, it means that when you are depositing fund with central bank, you will deposit your fund in the SDF window at 27.25. And also, if you are trying to actually borrow from the SLF window, that's a standard levy facility window, you have now borrow at MPR plus 300 basis points. That's 29.25%. And about since what we have seen in the recent past is even higher than that because of depth of liquidity in the market. As at this morning, the market opened with a repo that is negative of over 900 and something billion. And you imagine if the market is opening that much negative, it gives you an idea of where overnight and OPR rates will trade. As of yesterday, overnight and OPR rates was already trading about 31%. So it tells you that even cost of actually raising overnight funding for bank has gone up aggressively, and that is X the fact that there was a rate hike. Now that there's now another 150 basis point rate hike, and that we expect that also to impact the level of overnight and OPR rate. So it simply means that in no time we will start seeing rates in the overnight and OPR rates actually touching as high as 35 and maybe north of 35%. I think this will have aggressive impact on the income of banks.
But then, are there any other adjustments that could have been made aside this to further ensure liquidity and regulate the cash reserve ratio?
Well, I don't think the central bank has much in their armory to actually deploy this particular point in time. You've raised the CRR to as high as 45%. So the only limit that you have for banks is just about 55% to play with. There's 30% liquidity ratio to actually make. So it means that banks don't have so much firepower to actually deploy or actually give loans in this particular point in time. And this is in line with the expectation of the Monetary Policy Committee. They feel that this is not a time for banks to continue to give loan. This is more of a time for savings and rather a time for actually to continue to deploy funds into the economy. And the flip side of this is that I don't know whether the central bank is working with the fiscal policy aggressively on way to actually ensure that specific industry enjoy maybe a conservative or more like a discounted rate in this line, because you can't continue to actually say manufacturing company will continue to borrow at these high levels. You can imagine what impact that will be on the economy. We don't want to get to a level where most of these companies will not be able to actually produce, or will reduce production and need to start laying people off. And at the same time, you are trying to develop the agricultural sector. And when you're developing an agricultural sector, it's not a time where farmers will have to now actually access funds at this aggressive or high rate. So these are some of the things I feel that the central bank needs to work with fiscal policy guide for them to actually identify the specific sectors that they know that we need to actually continue to grow the economy as much as they are actually tightening on their parts.
Well, a lot has been said by you, Oladipo, about what the Central Bank of Nigeria needs to do to deal with the issue around inflation. But then let's look outside of the apex circle. What impact does external influences like interest rate changes by other central banks, global commodity prices, and economic slowdowns have or might have on the APC's decision?
You see, one thing is that some of those things, there's exogenous factors that sometimes if you don't if you don't consider your model very well, they'll creep in and actually distort it. And like you said, currently now we'll see what happened in the US. It seems that inflation is not going down anytime soon. And the expectation is that maybe by H2, we'll start seeing the Fed actually cutting rates. And based on what we have seen now, there's every tendency that it may take longer than expected now. So what that will mean is that the expectation that we'll start seeing capital inflow into our economy, it doesn't look as if it will come as fast as we have expected. So it simply means that we need to do more. And I guess maybe that's one of the reasons why the central bank went extremely hawkish to actually find a way to actually compensate anyone that is taking risks of coming into our zone. And the commodity price too is on the high side. Although we have seen some of them actually dropping, and generally, food inflation is expected to drop. Global food inflation is expected to drop. But the issue is that our exchange rate volatility is the factor that is actually making it worse for a country like Nigeria. We've seen sometime last year that wheat actually dropped by close to about 25 to 40%. But when you look at it in naira terms, it went up because of the exchange rate pass-through effect on the economy. So we need to ensure that there's stability of currency. And when we can ensure that there's stability of currency, of course, at that particular point, we will not feel the impact of the volatility of price of commodity in the global market as much as we are feeling it currently, because the expectation is that we expect price to drop in the global market.
Okay, before I let you go, Oladipo, what are your predictions now when all these come to bed in terms of policies? Because earlier on you talked about the need for patience for us to have a bit of change when, of course, all these policies begin to come into place. So do you think that the inflation rates might drop in about a couple of months? Should Nigerians expect, to heave a sigh of relief that things will normalize probably in a couple of months? Anything that they can make do with in about just a minute?
Well, if you look at the trajectory of the inflation already, I mentioned earlier on that when you look at month on month, it's already actually increasing at a high accelerating level. So it simply means that in no time we'll start seeing more like a drop in inflation. And that's why one of the reasons why I felt that maybe the central bank should have waited a bit to see the impact before they actually make such decision. But with the step that central bank has taken, it means that they want to quicken the effect. So it simply means that we should see inflation drop faster than we would have actually initially expected. And coupled with the fact that by H2, we start seeing more like base year effects kicking in, and that will also help to actually moderate inflation. And at the same time, from August, September, and October, we'll start seeing that's more like a harvest season. And such a time like that, we expect that to also help food pricing, and at the same time help food inflation, which in turn will actually dovetail into headline inflation. So we expect inflation to actually start moderating by H2.
Okay. Oladipo Ajayi, Head of Fixed Income and FX, Chapel Hill, Denham Securities. Thank you so much for sharing your thoughts with us.
You're welcome, bro.